NUBURU stock, trading under the ticker symbol BURU on the NYSE American, is experiencing volatile intraday shifts, sitting at a live price of $0.1415 per share, representing an intraday decrease of 2.48%, with a daily trading volume crossing 7.5 million shares. For a microcap entity sitting at roughly a $25 million market capitalization, a single penny move up or down shifts the entire narrative for day traders and retail investors monitoring this specific asset. If you look at online investing sites or open your retail individual brokerage account, it is easy to glance at this sub-quarter valuation and write the company off as another microcap company struggling to keep its head above water on a minor exchange. The general expectation among small-cap watchers is that companies under $1 are just burning cash, diluting shareholders, and waiting for an unavoidable reverse stock split just to maintain compliance with listing rules. However, the reality underlying this specific business is shifting in a way that the broader market has not fully recognized or priced into the stock. This week, the company signed a major international agreement to design blue laser technology for an underwater wireless power platform called DeepLight, working alongside the Italian firm SunCubes. This development creates a significant curiosity loop because it repositions a business that people used to view as a simple industrial component manufacturer into a highly specialized defense, security, and subsea infrastructure player. This unexpected change is forcing institutional observers who study macro trends via Interactive Brokers trading setups to take a second look. The common ground here is obvious. The general investing public sees a high-risk penny stock with a steep historical decline from its older highs. The contrarian take, though, focuses on how the company is aggressively expanding its defense and security framework by building an international alliance network, particularly in Europe. They are actively purchasing a 70% controlling stake in an Italian firm called Tecne, which has a massive projected revenue pipeline over the next 4 years, subject to clearing government regulatory hurdles in Italy. Investors using basic retail apps like the Robinhood app or checking simple charts on standard investing sites often miss the structural transition happening behind the scenes. They see a company that recorded just under $408,000 in revenue for its most recent quarterly record, alongside heavy operating expenses, which naturally spooks self-investing individuals who prefer clean balance sheets. When we break down the recent price movement, we can see that the asset has been under immense macroeconomic pressure and localized selling volume. Over the last month, the asset drifted down from 28 cents to its current 14-cent range, tracking a broader pullback in highly speculative tech components. Daily swings have been wide, often driven by retail volume spikes that hit the Robinhood trading platform whenever a new press release drops. Institutional activity remains exceptionally sparse, which is standard for an asset with a market capitalization below $30 million, meaning that price discovery is almost entirely dictated by short-term trading liquidity rather than long-term fund positioning. This creates a fascinating setup for retail traders looking for online investment opportunities with high asymmetric potential. For instance, when you look at how active traders use advanced platforms like the Interactive Brokers platform to gauge order flow, you notice that large block orders are rare, meaning a sudden influx of buying pressure from a small private fund can send this stock up by 20 or 30% in a single session. This high volatility requires immense caution, which is why a lot of conservative capital stays away, preferring established vehicles like Fidelity mutual funds or the automated diversification of a Schwab Intelligent Portfolios account. But for people looking for alpha in the microcap space, tracking daily volumes on a self-investing basis becomes a study in human psychology. The stock experienced an intense trading session following its announcement regarding its new defense laser arm initiative, which targets counter-drone and directed energy markets. The volume surged past its 30-day average as traders attempted to calculate whether a €1 million staged investment in European strategic partnerships would yield immediate revenue. The reality of the situation is that these agreements take months to convert into actual cash flow, creating a massive disconnect between the instant gratification expected by short-term retail buyers and the prolonged execution timeline of the company. Comment below how many shares of NUBURU you currently hold, or if you are completely avoiding microcap defense stocks in this volatile market environment. This disconnect is exactly why the price slumped back down to the 14-cent level, despite the flood of positive operational updates. Traders who bought the initial spike using basic Robinhood investments or fast execution retail accounts quickly realized that institutional accumulation was not following through to support the higher price levels, leading to a wave of profit-taking and short-selling that dragged the equity back to its local lows. To truly understand what this business does and how its model operates, we have to look past the current stock price and evaluate its proprietary technology. The core value proposition rests on industrial blue laser technology. Traditional industrial lasers utilize infrared wavelengths, which work perfectly fine for steel or iron, but are highly inefficient when dealing with yellow metals like copper, gold, and aluminum. Infrared light simply reflects off these surfaces, wasting energy and creating uneven welts. Blue light, conversely, is absorbed at a rate that is up to 20 times higher than infrared, allowing for incredibly fast, clean, and precise welds without melting or damaging surfaces surrounding components. This technological advantage is why the company originally targeted the electric vehicle battery manufacturing sector, consumer electronics, and aerospace production. They sell high-power blue laser engines and automated systems that integrate directly into industrial factory floors. Over the past couple of years, however, scaling this business model proved extraordinarily difficult due to the massive capital expenditures required by manufacturers to overhaul their existing assembly lines. This bottleneck is reflected in past financial performance. Older financial reports highlight a persistent cash burn, low initial commercial adoption, and severe net income losses that forced management to repeatedly seek external financing, diluting the share count and depressing the asset value on the open market. Realizing that industrial manufacturing adoption was moving too slowly, the executive team pivoted the business model towards a dual-use defense, security, and specialized communication infrastructure platform. This pivot is the exact catalyst driving their recent international expansions. By utilizing their blue laser technology through their Italian subsidiary Lyocon, they are expanding into the autonomous underwater vehicle market and directed energy counter-drone applications. Blue-green wavelengths possess the unique physical property of being able to propagate through water with minimal attenuation compared to other forms of electromagnetic radiation. This allows the company to build subsea wireless power transmission systems, enabling drones operating underwater to recharge remotely without returning to a surface vessel or docking station. Looking at the financial architecture of the business, the company is attempting to orchestrate an industrial turnaround through calculated acquisitions rather than relying solely on organic sales growth. Their planned acquisition of Techne involves a total structural commitment of up to 64.6 million euros, based on a pre-market company valuation of 52 million euros. Techne operates with a highly ambitious 5-year business plan that projects cumulative production values exceeding 560 million euros. If they successfully execute this turnaround and clear the stringent Golden Power review conducted by the Italian government, the company will gain pro rata access to a substantial international revenue stream that dwarfs its current historical performance. This structural shift is what differentiates the current version of the company from the historical industrial component supplier that struggled to gain traction in domestic commercial markets. For an individual managing an individual brokerage account, the central question is whether this tiny firm can successfully integrate these massive international operations without running out of capital. Investors seeking professional investment help or looking through online investing guides will find that microcaps attempting global structural pivots carry an exceptional level of risk. If the Italian government invokes its national security vetting powers to block or severely restrict the acquisition, the core growth thesis for the upcoming year could instantly dissolve, leaving the company vulnerable to severe liquidity constraints. This binary outcome is exactly what creates the profound tension between expectation and reality in the current market environment. Retail day traders are looking at the stock as a vehicle for quick percentage swings, expecting immediate price action from headline announcements, while the underlying reality is a multi-year corporate restructuring effort that requires regulatory patience, precise integration, and sustained capital access. When considering the future outlook for the company, there are several distinct scenarios that could play out over the next 12 to 18 months. In the most optimistic scenario, the Italian government grants full clearance for the Techne acquisition, and the joint initiatives with SunCubes move rapidly from the design phase into physical prototyping and field testing for Allied naval forces. If this occurs, the company could secure high-value defense contracts that provide concrete revenue visibility, allowing them to finally transition away from their historical dependence on dilutive equity financing. This would completely rewrite the expectation framework surrounding the stock, causing short sellers to cover their positions and driving a rapid re-rating of the asset towards historical valuation baselines. Conversely, a negative scenario involves extended regulatory delays in Europe, a failure to hit commercial milestones within their subsea power platform initiative, or a sudden cash crunch that forces another round of emergency equity issuance. Because the company operates with low cash reserves relative to its ambitious strategic goals, any delay in converting their opportunity pipeline into contractual orders poses an existential threat to its current corporate structure. For investors utilizing premium tools like the Interactive Brokers platform or executing long-term strategies through a Fidelity trading platform, managing exposure to an asset like this requires looking at it through a venture capital lens rather than a traditional equities framework. You have to assume high volatility and potential downside while weighing it against the unique technological moat that their blue laser intellectual property portfolio provides. As the broader market continues to monitor macroeconomic pressures, inflation data, and defense spending trends, the asset will remain a hypersensitive barometer for speculative sentiment within the specialized defense technology sector. To wrap up our analysis of NUBURU and its current market position, we can see a clear contrast between what the general market expects and what the operational reality presents. The market expects a typical microcap stock stuck at 14 cents to continue languishing under the weight of historical financial losses and structural obscurity. The reality is that management is executing a high-stakes international pivot into the directed energy defense and subsea wireless power markets, leveraging proprietary blue laser technology that solves genuine physics limitations found in traditional infrared systems. By utilizing international alliances and pushing through major acquisitions like Techne, they are attempting to buy their way into massive industrial and defense pipelines that could completely alter their revenue trajectory by the end of the decade. However, the path forward is filled with intense execution risks, regulatory hurdles, and persistent capital constraints that will test the patience of even the most aggressive self-investing individuals. Whether you track this stock on a basic mobile setup or evaluate its order book via advanced institutional trading desks, the asset represents a classic study in microcap turnaround dynamics, where the gap between current market perception and future operational reality will ultimately determine the ultimate destination of shareholder value. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Buy, comment, and share this video to support the channel.